For today's video, I wanted to talk about how to manufacture business credit, right? And what I mean by manufacturing business credit is strategically utilizing business credit accounts to report and then using your transaction activity and behavior to get bigger lines of credit. And now I dropped a video the other day about business credit accounts that report to Equifax business and specifically Experian business, right? And so once you acquire some of these accounts, you can leverage these accounts to build transaction data that's not only going to build more thorough and extensive relationship with your banking partners, but also you're going to be building business credit, right? The type of accounts that you really want to focus on are financial trade accounts. Now, financial trade accounts are going to be business credit cards, business lines of credit, as well as business loans, auto vehicle loans, equipment financing, because these are actual, promissory notes that you're signing, where you're making a fixed payment, or maybe you're making, payments on these types of accounts. It's not vendor to vendor or business to business types of accounts, or net 30s, so to speak. Now, once you get a handful of these accounts that actually report, you're going to strategically use these. I'm going to show you exactly the way that you want to use this. So when you're transacting in your business, you never want to use your debit card, right? Because for one, they usually don't earn any types of rewards or any types of points. And number two, you're also leaving your account vulnerable, right? Your money is at stake. The money that you work so hard for in your business is at stake when you're using a debit card. Another thing too, let's say there's some unauthorized transactions. With a credit card, it's easy to dispute those transactions and get credited, right? But with the debit card, what happens is it's a little bit more extensive of a process, and sometimes you're not always credited back with your money. So usually you'll have to sign like an affidavit, file a police report, and it's just a messy situation, right? So never want to use a debit card. So with your business, when you get these accounts to report, you want to transact using business credit cards, okay? So you're going to transact with business credit cards. You're also going to leverage lines of credit with the business credit cards. So what you're going to do, let's say you're transacting with these credit cards, revolving credit cards, and then, let the balances add up, right? So don't immediately pay it off in full. I know a lot of people say, pay your balances in full. But on the business side, since a lot of these credit cards don't report personal, it doesn't really matter if you have a higher utilization. In fact, on the business side, a lot of credit card issuers like to see that you're actually using what you have available. And so what you can actually do is just let some of those balances increase a little bit, maybe 2 to 3 months, just make the minimum payments. Yes, you're going to pay a little bit of interest. That's not that big of a deal, right? Because on the business side, the interest is tax deductible. Also, the way I look at interest on the business side is that that's the cost of building a relationship. Because remember, right, lenders want to extend to borrowers who are profitable for them. So if you're transacting a lot with their credit products and you're paying your balances down, or you're just a low risk customer, they're going to be more willing to extend to you, right? So if I'm a portfolio manager, I want to maximize profits for the company or the financial institution. So I'm going to lend to the most, I'm going to deploy resources to the most profitable customers. And the most profitable customers are the customers who are low risk, meaning that they have stellar repayment history, steady deposits and income, and those who are transacting with the accounts, right? So you're going to use the credit cards, transact with them. And then with the business lines of credit, what you'll do is, let's say every quarter, you draw down on the business line of credit. So you transfer from the business line of credit to a checking account, but not just any checking account. You want to have at least 2 checking accounts. You have one where it's just money going in, so it's just showing income, and then another one where it's being used to pay for expenses. So real quick, one of the main reasons why you want 2 checking accounts on the business side, so you have an account at the same institution, right, where you just have all your income flowing in, and then you have another account where it's being used to pay your expenses. Now, the reason why you want these 2 different accounts is because when you're applying for funding and you want to maximize your funding potential, you want to show as much income in that account. And a lot of institutions are going to ask you for like 3 months of business bank statements, right? And so if you have, let's say 3 months of bank statements where it's just mainly showing revenue flowing in and very low expenses, is going to look more favorable for you. So if you're just looking at the bank statements, it's not going to show much dips in your bank account, right? And it's going to show your average daily balance increasing month over month. And if you can show that over a 3-month period and you're strategically, mapping out when you're going to be applying for funding, it's only going to maximize your potential for getting approved for business funding. So what you're going to do is you're going to transfer from the business line of credit to the expense checking account, business checking account. And then from that checking account, you're going to use the funds that you transfer from the line of credit, use that to pay off the credit cards. So what you're doing is you're creating multiple payment experiences, right? So you're transacting with the business credit cards, but then you're also drawing down on the line of credit. You use the funds that you transfer from the line of credit to the expense checking account to pay off the business credit card. So then you bring all those business credit cards to zero, but now you have a balance on your business line of credit, right? And so then ultimately, let's say, twice a year, you might then transfer money from your checking account that has all your income flowing in, transfer that to the other checking account and use that to pay down the line of credit. So what you're doing is you're pretty much, manufacturing data by transacting with the business lines of credit and with the credit cards, and then using your funds eventually to pay it down. But what you want to do, you want to run up some balances, right? I know a lot of people say pay your credit off in full, but if you want to build credit on the business side and you want to get access to higher lines of credit, you're going to have to show a demonstrated need. And the best way to show a demonstrated need is to use it. Now, I talked about this in other videos where, let's say you want to increase your line of credit. Now, a lot of with a lot of institutions, the way that you demonstrate that you need a higher limit is by touching up against the limit of the credit card. Because let's say if you have a high limit, let's say you have a $30,000 limit, but you're only spending $500 a month, it's going to be harder to get a credit limit increase, right? And the reason why you want higher limits reporting on your business credit. And what's more important when it comes to building business credit is showing, that you're making large payments. So what I was talking about with the line of credit, right? When you draw down on the line of credit, you're going to be drawing down a pretty decent amount, because remember, what you're drawing down on the line of credit is going to be used to pay, let's say 2 to 3 months of expenses that you racked up on the business credit cards, right? And so when you're making those payments, first of all, on the credit card, it's going to show big payments. And then when you ultimately pay back the line of credit, it's going to show a large payment as well, right? Business credit reports show the last payment, right? So your Equifax business credit report will show your last payment. So recently I made a $55,000 payment on my Truist business line of credit. And the line of credit, the $55,000 that was racked up, was from paying down the business credit card multiple times over several months. And so what I'm basically doing is manufacturing data. Now, let's say you don't really have all that many business expenses, but you still want to manufacture data. You could still draw down on the line of credit and then use the same money that you drew down to pay it back. Now, and of course, a lot of people want to say, oh, you're paying unnecessary interest. Just think about it long term. If your long-term goal is to position your business so that you have as much capital as possible, whatever little interest that you're paying, it's just the cost of positioning yourself and building that relationship. So that's pretty much how you build business credit, by manufacturing data using business credit cards and business lines of credit. That's all for today. Until next time, take it easy, and we'll talk to you soon.